Hello and welcome. Today, FXCM has put together a very important presentation surrounding the events of the Euro-Swiss flash crash on January 15th, 2015. We know there have been many articles, posts, and news commentary written about the SNB announcement, which impacted the Euro-Swiss and thus FXCM. We at FXCM felt it was very important to compile data that is available to us, but many may not have access to, which will take you through the events of January 15th, 2015. This data is not only insightful, but provides everyone with a more detailed overview of the Euro-Swiss flash crash. First, please read through the following disclaimer. Forex Capital Markets Global Group, FXCM, has calculated data to the best of its ability. The data is accurate as of February 18th, 2015. If additional facts arise, the material in this presentation is subject to change. In some charts, there is an estimated bid and/or ask displayed. Because FXCM circuit breakers halted pricing, the system did not generate a best bid ask, so FXCM used the same calculations to generate the estimated bid ask. Now, to summarize. The market activity following the Swiss National Bank announcement of January 5, 2015 was in fact a flash crash. The purpose of this presentation is to educate and explain how market liquidity disappeared and created highly volatile prices that were not executable. This was very similar to the 2010 flash crash seen in the U.S. equities market, which resulted in a 9% move in the Dow Jones Industrial Average within minutes. The severity of this event created greater than a 40% move in Euro-Swiss within mere seconds. FXCM technology functioned properly in the midst of this chaos, similarly to the manner in which FXCM technology operated in the Lehman Brothers collapse of 2008, as well as the Japanese earthquake of 2011. So what was the difference with the Euro-Swiss flash crash? The institutional FX market completely broke down. How? The available effective executable liquidity was nearly zero for the span of nearly 40 minutes. Several Tier 1 institutional platforms were flashing prices as low as 0.200 and 0.500 on the Euro-Swiss pair. Reflecting the interbank market didn't know what the market prices were for Euro-Swiss. There were extreme spreads between 2,000 and 3,000 pips in Euro-Swiss, with extreme ranges of about 6,000 pips. This was truly an extreme FX market event. FXCM has long run a no dealing desk or agency execution on its FX business. For it to function efficiently and effectively requires the institutional market to provide prices and executable liquidity. However, on January 15th, the SNB announcement caused a complete institutional breakdown and a complete market dysfunction. FXCM systems allowed most of our clients to exit trades between 102 and 104 and avoid the extreme lows of the event. We know it was a very large decline, but this wasn't an FXCM system failure. The failure of the institutional market to provide pricing during the event ultimately resulted in some clients having negative balances with FXCM. The agenda covered in this presentation will be as follows. Explanation of the FXCM agency execution model, timeline of events on January 15th, 2015, further details regarding extreme market liquidity, volatility, and spreads, quality of execution, measuring how executable specific prices were, importance of FXCM circuit breakers, and observations and conclusion from the event. To start, it is good to remember and understand that FXCM runs an FX agency model, which is different than many other brokers. FXCM pioneered this in 2007. In this model, FXCM acts as a middleman as we receive prices from our liquidity providers and pass those prices and spreads on to our retail audience. In many jurisdictions, FXCM doesn't add a markup, but instead charges a per lot commission as our fee. So the exact spreads that we receive from liquidity providers in the interbank market go to the retail trader without a markup. We feel this model is transparent and fair for retail traders. It means that as we are given price and liquidity from our providers, we execute every FX trade by our clients back to back with the liquidity provider. FXCM does not take a position against our clients like many other brokers. In FXCM's no dealing desk execution system, trades are matched one for one with a liquidity provider, which is a very important distinction. What does this mean? When a client profits in the trade, FXCM gives the profits to the customer. However, when the client is not profitable on that trade, FXCM ends up having to pay the equivalent amount of the loss to the liquidity provider. This is very important to understand in the context of January 15th, 2015, as all of our liquidity providers ceased pricing and providing effective executable liquidity, which caused significant trading losses. While clients could not cover their margin call with FXCM, we still have to cover the same margin call with our liquidity providers. Now, a question asked is, why weren't other brokers impacted similarly? The reason is simple. Many other brokers run a dealing desk execution model. Thus, they are on the opposite side of many of their client trades. This means as clients lose money, the dealing desk broker profits. In this case, many traders lost money as clients were mainly long Euro Swiss throughout the industry, which means these brokers made profits in some cases. The SNB announcement was an extraordinary FX market event. How extraordinary? Well, this chart shows how the spreads and ranges for Euro Swiss during the Swiss National Bank announcement compared to other historical FX market events. During the 2008 Lehman Brothers collapse, pound dollar and pound yen never surpassed spreads of 20 pips. The same was with dollar yen during the Japanese earthquake. Compare that against Euro Swiss, which had a spread range above 2,000 pips. Even more extreme are the range of prices per minute. The Euro Swiss has a maximum range of prices per minute of more than 5,000 pips compared to the other events. Note, the blue bar shows the total move during the period, from the high before the event to the low during the event. This is very evident that the SNB announcement far surpasses previous events in the FX market and was extraordinary. Now, let's take a look at the timeline of events. Remember, we had an extreme fall in prices and liquidity within seconds. What we have done here is break down the events as they occurred after the SNB announcement. As you can see from the above timeline, Euro Swiss moved nearly 400 pips in the span of the first 9 seconds from 120 to 116.59. Within the first 10 seconds, FXCM system circuit breakers deployed to halt new quotes and trading. These circuit breakers are designed to protect clients against erroneous quotes and off-market prices. In the next 12 seconds, the price moved an additional 600 pips, a total of a 1,000 pip move in the span of 21 seconds. During this time, over a dozen of our liquidity providers ceased to make a market in Euro Swiss. EBS is often used as the benchmark or reference for the institutional market. At 431.43, they're quoting Euro Swiss at 1.000, showing complete market dysfunction. Within 3 minutes of the 120 Euro Swiss floor being breached, the institutional FX market was in a state of panic, exemplified by one major international bank quoting a bid of 0.6374, representing a move of over 40% in 3 minutes, an unprecedented move in a major currency pair. ECNs showed extreme quote ranges going as low as 0.5000, even on EBS. Over the next 35 minutes, the price of Euro Swiss continued to fluctuate by literally thousands of pips per second before finally stabilizing around the 1.0400 level, nearly 5,000 pips higher than the low bid received during the height of the dysfunction. 13 minutes later, at 5:23 a.m. EST, FXCM system resumes execution and the circuit breakers are removed. Liquidity levels are as little as 5% of normal levels, and only 3 or 4 liquidity providers are quoting consistently. As you can see from the timeline, the interbank market was in chaos with prices in an extreme range. The circuit breakers helped to ensure trades weren't executed at the lower far-off market prices. This snapshot shows that the majority of liquidity providers stopped pricing at 4:30. The yellow line represents 4:30 a.m. Eastern when the SNB announcement was made. The institutional market effectively stopped pricing for an extended period of time, and thus FXCM couldn't execute stops or margin calls. Generally, liquidating trades in normal market conditions would be quick, but instead took much longer as our liquidity providers were not making markets. FXCM maintains a wide range of providers, so that if a few providers stop pricing, there is no effect to FXCM's clients. In this case, however, more than 10 providers effectively did not know where to make the market in Euro Swiss, which was the cause of the panic across the industry when it came to pricing Euro Swiss. FXCM had nearly 1.17 billion in total Euro Swiss sell orders. Again, 1.17 billion. The average quoted bid volume after 4:30 a.m. was 7.5 million, Again, 7.5 million compared to 1.17 billion. Now, in later slides, we will show why the 7.5 million was actually not an accurate reflection of executable liquidity. The effective executable liquidity would have been much less. This chart shows the decline in liquidity during the timeline of the event. In normal market conditions, there are about 20 active liquidity providers and quotes good for 60 million on each side, both bid and ask, that refresh every few seconds. Here, executable liquidity drops to basically zero 2 minutes into the event. This means that as Euro-Swiss was dropping from 120, FXCM had little ability to execute client stop orders or margin calls because there was almost zero effectively executable quotes with liquidity until about 45 minutes later when the market began to stabilize around 104. Again, referencing EBS, you see a similar decline in quoted volume at 4:30 a.m., as well as levels of market depth across the interbank market, showing the true systematic nature of this event across the FX industry. Furthermore, this chart is a snapshot of a 4-minute period after the announcement. The chart shows some of the major ECNs. You'll see on the chart plenty of white space. This shows a lack of quotes and therefore a lack of liquidity throughout the time frame of the event. Historical significance. This chart shows how severe the decline in available liquidity compared with recent major market events from 2015, effectively showing that available liquidity in Euro-Swiss dropped to zero. Following the previous slide, here you more clearly see the comparison side by side in available liquidity in Euro-Swiss for the SNB event compared to Euro-Dollar and Dollar-CAD during jobless claims and the Bank of Canada rate decision. This again exemplifies the complete lack of liquidity available across the market in Euro-Swiss compared to other recent market-moving events. During the SNB event, you had extremes in volatility. The normal price range of about 2 pips drastically and rapidly changes to over a 5,000 pip range within just a few minutes. A nearly 6,000 pip range, again, an extraordinary FX event. EBS is often used as the benchmark or reference for the institutional market. This chart shows the range of bid and ask prices during the SNB-induced market volatility. As spreads widened and volatility increased, the maximum range of ask prices in a 1-minute period surged to 12,000 pips, while the max range in bid prices increased to over 5,000 pips. This chart compares the range of prices of Euro-Swiss on January 15, 2015 to the two aforementioned market-moving events of 2015. Euro-Dollar following the U.S. jobless claims announcement on January 22, 2015, and Dollar-CAD following the Bank of Canada interest rate decision on January 21, 2015. Max ranges: Euro-Dollar, 108.7 pips, Dollar-CAD, 216.9 pips. The Euro-Swiss had a range equal to 5,582.1 pips. This timeline shows the decline in liquidity following the SNB announcement. From 4:30 a.m. Eastern to 5:10 a.m. Eastern, only 1 to 2 of FXCM's liquidity providers were online, and their quotes were thin and highly unreliable. This caused FXCM system circuit breakers to deploy to halt new quotes and trading. These circuit breakers are designed to protect clients against erroneous quotes and off-market trades. The FXCM system circuit breakers deployed early, helping clients to avoid the lows you see in the chart. Expanding this analysis to the network of major ECNs, we can see that this event was systemic across the industry and not an FXCM-specific issue. Several ECNs were quoting bids literally thousands of pips below 120 within minutes of the SNB announcement, a truly unheard of occurrence. This chart drills into the bids of one of the top global ECNs, EBS, an ICAP company. The gaps in EBS bids show several periods where available liquidity was literally zero. The volatility was so severe on EBS, bids as low as 0.5 were being quoted within minutes of the announcement. For a 2-minute period, consecutive prices were bouncing between 0.5 and 0.95. This is almost 100 times the daily normal range for Euro-Swiss. Average spreads for minute-long periods exceed 2,000 pips. Normal spreads in Euro-Swiss before this event were 2 to 3 pips. These charts analyze the normal interbank spreads across EBS, a leading ECN in the FX market, which counts top-tier banks, hedge funds, HFT firms, and FX brokers among its clients. Normal interbank spreads in Euro Swiss were 1 to 2 pips. Here, the spreads are thousands of times those figures. This shows that across the entire FX industry and all major participants, literally no one knew where to make a price in Euro Swiss. Let's take a look at the max spreads with other recent events versus the SNB announcement. The max spread during a recent U.S. jobs announcement was euro-dollar 11.5 pips. The max spread during a recent Bank of Canada rate decision was dollar-CAD 84.5 pips. The max spread during the SNB announcement for Euro Swiss, 2,649.6 pips. As shown in previous slides, prices were extremely volatile and liquidity deteriorated rapidly. Accordingly, quality of execution deteriorated rapidly across all liquidity providers as well. In the first 5 seconds after the Euro-Swiss price moved below 120, the institutional market functioned. FXCM executed trades extremely efficiently at greater than a 100% execution to quoted volume ratio. In the next 5 seconds, when the institutional market failed in providing liquidity and pricing, execution of trades rapidly deteriorated. The spreads, ranges, and the volatility were all extreme. FXCM had no control of the extreme price movement, the erratic pricing, and the effect of liquidity after the SNB announcement. FXCM's technologies did engage our circuit breakers. The system automatically deployed circuit breakers shortly following the SNB announcement that halted pricing and execution until the market stabilized. Using the execution quality ratio described in the previous slide, we can estimate actual execution quality versus potential execution quality without circuit breaker safeguards. For the purposes of this analysis, an optimistic 18% ratio was used, corresponding with the ratio in the 5 seconds before the circuit breakers deployed. There was just over 1.17 billion in Euro-Swiss sell volume. As shown in previous slides, the quality of execution was deteriorating rapidly after the announcement. In reality, quality of execution could have been much worse given the true market conditions. FXCM executed all sell stop and margin call orders at a weighted average price of 1.0549. FXCM systems allowed most of our clients to exit trades between 102 and 104 and avoid the extreme lows of the event. If FXCM circuit breakers had not engaged, the weighted average price of the same orders would have been 0.9760. The estimated savings to FXCM clients due to circuit breakers, approximately $104 million. As shown earlier, the Euro-Swiss move on January 15, 2015 was extraordinary. FXCM's lowest price of execution on a sell Euro-Swiss order before 6 a.m. was 103.08. This was a large move of 14.1% even with our circuit breakers turning on. Based on the extreme moves on other ECNs, the move could have been much larger without our circuit breakers. Thus, even with higher margin requirements on Euro Swiss, if clients had been fully leveraged, the losses could have been similar. Now, a couple of observations. There were no circuit breakers at each level of market participation. Whereas FXCM had circuit breakers which aided our clients in this extreme market movement, the institutional marketplace did not. The market could have been functional if circuit breakers existed at every level. Like many have said, the 120 SNB floor was completely irresponsible. There was no active management. Instead of the SNB moving the floor down gradually or providing proactive information, a decision was made leading to historic market dysfunction. The perception of the Euro-Swiss floor was that it was a real rate. Instead, it was more analogous to exchange rate manipulations of developing nations. In conclusion, the institutional FX market failed and did not function. As you can see from earlier slides, the effective executable volume was extremely low. As our NDD model requires the institutional market to function efficiently, during the SNB event of January 15, 2015, it did not function. This resulted in a historic and extraordinary FX market event.